Hello and welcome to the Investing on the Go podcast. I'm James Yardley and today I'm joined by Manish Bajaj, the elite rated manager of the Brown Advisory US Flexible Equity Fund. Thank you very much for joining us today, Manish.
Thank you very much for having me, and it's great to be speaking to you.
Manish, tell us a little bit about the US. What is the situation at the moment? We've heard a lot about inflation at the moment and supply chain worries and so forth. Are people coming back to work? And what is the overall economic position at the moment?
Sure. So things are progressing, and things are progressing well. There are challenges, however, and you referenced a couple of those challenges. So when I reflect on year to date, we've had the third quarter where there was the Delta variant, which has provided some bit of dent related to the growth and consumer sentiments in quarter three. We've had good growth in quarter one, quarter two of this year, but the GDP growth for quarter three came subpar and it was under expectations. So for example, the GDP growth in quarter two was 2% versus 6.7% in the earlier quarter. The expectations are that we will recover, things will get robust and will progressively get better from here. And economists are forecasting above average growth for 2022 as well. Now, just reflecting on how the investors are thinking about it, the equity markets, the Dow Jones hit 36,000. So investors are really seeing through some of these issues and viewing them as mostly temporary. James, you talked about are people going to work? And they are. And I can tell you from my personal experience, when I'm driving in the morning during the rush hour or coming back from the office, it feels like pre-pandemic. So I am stuck in traffic, and so which in some ways is reassuring that things are getting better. You also talked about inflation, and we do have inflationary pressure. As you know, the inflation environment in the United States has been pretty benign over many couple decades. And what we're finding is that inflation has perked up. It started perking up in March of this year, which was really not expected. The Fed last year in December was forecasting 1.8% inflation in the United States. We are far from it. Inflation, the latest readings have been above 5%. So we are seeing inflationary forces there, no question about it. And you really have to go 40 years back to see such kind of inflation. Now, inflation is very, very hard to forecast. And as I mentioned, even the Fed finds it difficult to forecast it. And there are supply issues, which could be temporary. We are finding in the United States that there are supply disruption, and it's across the board. It's in the commodities, it's in the chips, the semi industry, and because of it, many of the end products like cars, phones, they're getting impacted. So the bottlenecks really have been in multiple areas, and that's why, which is leading to these supply constraint issues. It's shipping containers from China, and there is a shortage of containers. There is shortage of trucks. There is labor shortages. There are not many drivers to haul many of the goods away from these ports. So what we're finding is there is port congestion as well. Ultimately, all this will resolve itself. And the question really is, how long does it take to go through it?
Now, what does it mean for sort of earnings and margins? Are we still seeing stronger earnings? Are margins sort of getting compressed at all by higher input costs, or is it more of a case of winners and losers?
Absolutely, you're going to see there is going to be margin compression, and simply because wages are going up, but also the companies are able to pass on pricing, and that's what is leading to this inflationary pressure. Right. So this is really a tug of war, and ultimately it'll depend on the business model, what business model you own. Many of the holdings which we have in our portfolio, especially the bigger ones, the impact on those business models related to commodities or labor pressure are not that acute. So It's to be seen. The earnings are going to grow very, very nicely in 2021 over 2020. And that's simply because 2020, because of the pandemic, the earnings were depressed. I think the key question is, how does 2022 play out? We do think that there is going to be expansion and the GDP is going to grow nicely, and companies' profitability also should increase nicely.
And looking at your holdings, I notice you own Visa and MasterCard, as quite a lot of other managers do. Why do you need to hold both? And what do you particularly like about these businesses?
Sure. So Visa and MasterCard have been very, very long-term holdings of Flex Equity. And we've had it for a decade or more. These positions were much smaller in the portfolio when we bought it at the time of purchase, but since then they have grown in size as the stocks have done well. Between the two companies, there are more similarities than differences in their businesses. The key point is that these are wonderful businesses. They are toll booth-like businesses. They have built a powerful two-sided network. These businesses have very, very high margins. They have very high returns on capital. And they have benefited over the last decade from the secular shift of cash to digital. And increasingly, just what we've experienced related to the pandemic, more and more commerce is shifting online, and Visa and MasterCard are clear beneficiaries of that. So there is not one clear case that one is better than the other, although there have been periods when the stock performance of one is better than the other. And there are some differences. Visa is a much larger company. Its revenue is roughly 50% more than MasterCard. And because of the scale Visa does have better margins than operating margins than MasterCard. Visa also dominates the debit card market in the United States. And debit has been doing well in the current environment where consumers in the US are flush with cash. And the use of credit card is not as much as the debit. However, MasterCard has been growing faster. They have executed well in Europe. And in the past few years, Visa got mired with the merger and integration of Visa Europe. So MasterCard has shown some good growth in rest of the world. So, and one difference is also that MasterCard was early in building a consulting business. They provide additional value-added services to their customers. So generally speaking, these are terrific businesses. They have been in our fund for a long time. And we often in our fund, once we have winners in our portfolio, we continue to ride them. And these companies have continued to grow in value for our clients.
And I also noticed you own Pinterest. Can you tell our listeners what Pinterest does and what you like about the company?
Yes, very happy to. So Pinterest is a social media company where people come on their websites to get inspired. It is a visual discovery engine for finding ideas like recipes, home and style inspiration. Interestingly, what happens is that these ideas have been created by the pinners or the members on Pinterest, and which is shareable. So it is actually, the concept is I think it's a great idea. It's a powerful idea. Oftentimes, for example, if I'm looking for a lamp, my search may start on Google or a search engine like that. But once you search and once the results come out, it doesn't get simpler from that. I can go to the various websites. I want to maybe, save some of these websites or images, and there is no way to do it. Cut paste is not a great option. And Pinterest is a website or a social media platform which allows me to pin these images and website addresses onto my own board. And this board becomes available for others or my friend circle or others to view and get inspired by. So maybe, James, you may have great taste and you're upgrading your kitchen. And I want to get inspired and look at your selections. And that's easy for me to do on Pinterest, is to follow your board and see how you're thinking about your kitchen upgrade. So we like this space. I think it's a unique platform. social media has had a secular tailwind when it comes to advertising dollars being spent on those platforms. We've seen Facebook, we've seen Snap, revenues for these companies have continued to grow. And if you think about in aggregate, the revenues for these companies on social media platform has grown more than 25% for the last 7 years. So there are secular tailwinds for companies like Pinterest. In case of Pinterest, the company went public in 2019, and since then they have grown their revenues and also their profitability quite dramatically. They have built a strong community. They have more than 450 million monthly average users, both in the US, maybe roughly 90 million, and rest internationally. So over the years, they've been building tools and making it convenient for advertisers to advertise on their platform. So James, I referenced about the kitchen upgrade, which you may be thinking, and you've created a board for it. It's a perfect place for advertisers to advertise maybe the sink you're looking at. And so it just becomes convenient for you to see other ideas as well. And what's important is that those pins which are being advertised can become shoppable. So, and this is the big opportunity for Pinterest as they build their platform to make it more shoppable. So we like their prospects. It's a young company. There are, of course, execution challenges, but if they're able to execute on the opportunity, we think that they have tremendous growth ahead of them.
Very interesting. And how are you thinking about ESG at the moment? We hear a lot about it. Does it form an important part of your process?
It does. And so environmental, social, and governance issues have increasingly become important, not only to the population, but also to the investment community. And as long-term shareholders of companies, we have always thought about these issues. But in the last 4 or 5 years, we do it much more explicitly than we have done in the past. And this is now very well integrated in our research process. We have an ESG team which does deep work on understanding the ESG issues related to the companies and the industry the company operates in. So we do have an ESG policy, we have a framework, and in very simple terms, we like to invest behind companies that take their responsibilities towards the environment, social aspects, and governance seriously. And we want to avoid investing in companies that are breaching global norms. And the last bit is, which is a critical piece, is that engaging with these companies to understand their policies, etc., and also share ideas and help them get better. So every company we look at, every new investment opportunity, we have ratings. We rate these companies based on the ESG risk profile and the opportunity. We engage with these companies to monitor the risk, the progress the companies are making related to their ESG goals. So to your question, ESG today is a significant portion of our research efforts and in our investment decision making.
You talk about active engagement being central to your approach. Can you give us a few recent examples of some conversations you've had? Sure.
I'm assuming, James, that you're talking about ESG-related engagement. Is that right?
Yes.
Sure. So, as I mentioned to you earlier, that ESG is an important part, and we care deeply about it. We recently made an investment in Bed Bath & Beyond, which is a new holding of ours. Our ESG team engaged directly with their management team to understand the ESG issues. How the company is approaching ESG and integrating ESG into their business practices. So for us, it's critical to understand, for example, where are they sourcing their cotton from, or they make bed sheets and towels, etc., and just trying to understand if they're emphasizing organic cotton, for example. Is the company focused on reducing waste? So how are they intending to reduce their footprint related to plastic or related to energy? So just trying to understand their energy footprints and their goals, etc., to reduce their usage of plastic and maybe also reduce their distribution cost. Another example is Nomad. Nomad is is primarily based in Europe, and it's a consumer staples company. They sell frozen fish and frozen vegetables. There was a recent documentary on Netflix. It's called Seaspiracy. If you have not seen it, I think it's fascinating. It's interesting. It draws attention to, in many ways, how the seas are being plundered for fish. And so this called into question their sourcing and their brand was mentioned related to sustainable fishing. And so we reached out to Nomad to understand better their progress and how they are working towards sourcing more sustainable fishing. And so this is a critical part of what we do to understand and the progress companies are making. And in this case, they are committed to having more sustainable sourced fish. And they have set a goal to be certified by the Marine Steward Council or the Aquaculture Stewardship Council. So we see company making good progress related to that. And they're also on proxy voting. We take our responsibility related to proxy voting very seriously. Our teams engage with all the companies when it comes to proxy voting. Recently, we've had a dialogue with Edward Life Sciences Corporation, which is a holding in our portfolio, to better understand many of the measures that were on the ballot, to understand the ESG topics like succession planning, diversity and inclusion, product quality, etc. And these dialogues help us understand better where the management teams are coming from, and allows us to vote in a more responsible way and a thoughtful way.
Well, that's been really interesting, Manish. Great to get your thoughts today. Thank you very much for joining us.
Most welcome. Thank you for having me.
And if you'd like to learn more about the Brown Advisory US Flexible Equity Fund, please visit FundCalibre.com. And please also remember to subscribe to the Investing on the Go podcast. Please remember we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at your time of listening.